The conversation is that everything good is going to be baked into the market, so we're just going to roll over. It shows late cycle, and it's going to be not a great back half of the year. What's your read?
Well, I think that, we still have the fiscal stimulus that's still working its way through the system. And now over the weekend, President Trump has promised something about a large middle-class tax cut, which seems like Congress isn't quite sure about. They are talking about making those middle-class tax cuts permanent. But for me, the big driving force here is the combination of fiscal stimulus and very gradual monetary tightening. And when I mean gradual, for the current generation, it seems like once a quarter, that sounds aggressive. But remember what Greenspan did, a quarter basis point hike at every meeting. And so I think that this is very gradual, and I think the market's right to look for a December rate hike, almost regardless of what the high-frequency data shows.
Well, but the fiscal stimulus also, we've gotten that to a large degree already. And you're right that there are proposals in Congress, but Senate is going nowhere with making those permanent. And we don't know what the president's talking about. So what is the danger, actually, that, the delta will be reduced? I mean, we had the fiscal stimulus, but it's not going to get better.
Sure. So, so I think you're right that there's going to be some fiscal stimulus still in the pipeline, and that'll carry us into what I think is going to be the middle of next year. I know a lot of people are talking about a downturn in 2020. I think the slowdown comes beginning in the middle of next year, which is why I think the market is saying the Federal Reserve says 3 rate hikes next year. The market's saying maybe 2.
Well, I like what you're saying, because we're hearing from all the big banks too, like when we're going to see a recession. Well, Howard Marks of Oaktree weighed in. He said we're nowhere near that right now.
Look, our economy is still doing very well. In a few months, it will become the longest recovery in history. And I don't believe there are signs of recession anytime soon.
And Goldman saying the opposite. If you come inside the Bloomberg, Mark, this is what they were talking about over the weekend. You have the white line is the S&P, and then the blue line is the Goldman Sachs U.S. Financial Conditions Index. Higher it goes, the more you're tightening. And they're saying basically the stock rally is not going to be good enough in the back half of the year and next year to sort of help offset, and you're going to see a slowing economy. You're going to see tightening financial conditions. Yeah,
I always think that you see some signs of the higher interest rates having a bite. You see this in the housing market. We had a series of weak data last week on the housing market, and also auto sales. Those are 2 interest rate sensitive sectors. But also I'm looking at some other late cycle developments, and we'll see this again next week, in 2 weeks, non-farm payrolls. Typically the 12-month moving average peaks in the middle of a cycle. We peaked in 2015. So I agree with Marks that we're not headed for a recession imminently, but I do think that we're going to get a slowdown beginning in the second half of next year, slow enough to get the Federal Reserve to pause.
Well, and yet we have the Fed again and again and again saying we think we should keep hiking because, in fact, the fundamentals of the economy are strong. We're going to get GDP numbers on Friday. We'll see what those say. But so you're really caught between 2 forces here.
Yeah, so I think that what the Federal Reserve says, in effect, is we're going to raise rates until we see some evidence that we've gone too far. And the evidence for too far is this economic slowdown. So far, it hasn't materialized, but I'm thinking it will. I'm thinking that we probably peaked in the economy second quarter with that 4% handle on GDP.
Okay, so did we peak in the dollar and peak in yields?
I'm not sure we've peaked on yields or the dollar yet. I think there's still another push. Partly it's the Italian story. Partly it's the interest rate differential. We're still looking at the ECB not hiking rates till after next summer. So by which time the Federal Reserve will probably hike rates 3 more times.